Well, the sell side continues in these markets, and the rotation to more risk off defensive sectors continues to be the play. In today's Stock Market Brief Show, we're going to hop into some of the big picture charts. We're going to be diving into some of the divergences that we talked about when we were leading up to the all-time high in the market, because I think it's going to be important to revisit these if we start to see positive divergences form. We're going to go into market conditions and the expected moves. Really, we got to also talk about how we really haven't seen capitulation yet in the market. So all that and more on today's Stock Market Brief Show. For those that don't know, I'm partnered here with Interactive Brokers. So if you click the link in the description there or the pinned comment, make sure you check out their campus. They offer a whole host of free tools and resources, including courses from beginning to advanced. And also a big thanks to my Patreon group, which I don't talk about all too frequently or break down everything because there's so much that I offer for $9. You could also subscribe for the year and pay $90 and it's basically nothing for all the stuff you get. This little dot alone is a huge thing right here, which is a comprehensive set of tradie tick bots and the query channel. For example, if you log into the Discord, right, that's where the query channel is. You can type in various commands and you get charts for that stuff, and you have all types of commands where you can look at algo flow divergences, you can look at various gamma exposure levels. There's a whole bunch of stuff. You can look at unusual flow, whale targets, implied volatility, insider transactions, dark pool data, all types of stuff. But that's not even all of it. I give my weekly watch list, including my tight list, which are stocks from the watch list that are contracting. I post some trade ideas there. I give my zone documents, right? I give a lot of different stuff here. And then on top of all of that, I give my expected moves for things that have the daily option contracts. And now I've even included the Mag 7 daily expected moves. I do weekly, monthly, and quarterly there too as well. So if you haven't checked it out, make sure to check that out. Let's get into today's show. All right, people, welcome back to the show. So out of the 11 sectors that make up the S&P 500, we had one in the green, and that was utilities. Kind of bond related, right? There's a close correlation there. So utilities, more of a risk off sector. We had consumer staples up there too, down about 0.5%. And then towards the bottom, it was more of the risk on type sectors getting hit. And then across the board, some pretty big sell side activity. If you look at it from a year to date basis, what's been performing the best? We got miners, we got silver, we got gold, right? And when gold performs really good, it is kind of a curious sign to the markets. Gold is also not only known as a safety asset, it's known as a currency. So it's interesting to see gold, right? What's the market trying to tell us here? And then towards the bottom of the list, you got Bitcoin, which is supposed to be, right, a potential divergence from some of these risk on assets. Like people might use it for safety, but that just has not been the case. At least that was the narrative a while ago. So we got Bitcoin down about 20% here on Bito. BTC futures about 14%. Consumer discretionary is one of the laggards. IWM, which we're going to talk about in a little bit here, is down 10%. Semiconductors too. Qs are down 8.9% for the year. And some from these highs are actually in correction territory. So you can see the SPY is down about 6% for the year, but it's actually down 10% or more from its high. You can see a chart of gold here breaking out to new all-time highs. What is gold signaling to us? If you look at the rotation of the safety trade here, they've been picking up. There's gold relative to the S&P 500. Utilities has been picking up. Consumer staples, TLT has been picking up there too as well. Healthcare and defensive names as well, which is ticker symbol POWA. You can look at it in this way too, which is a relative rotation graph. You have things like healthcare rotating into the proving quadrant. You got consumer staples there. You got utilities there, right? When energy is improving or leading, that's typically not good for the S&P 500 either. And then what do you see in the weakening quadrant and the lagging quadrant? You got both our risk on assets right there. You got consumer discretionary, right? Things that people want versus the things that people need over here, right? And then you have tech as well as a lagging sector. And what I found very interesting today is I was over there on FinViz and I was like, what I'm interested to see how many stocks with a over 10 billion market are reaching 20% or more below their 52-week highs, because that would be considered quote unquote bear market territory. And so I ran that 20% or more on large cap plus, and it came up with 393 names. I've stacked ranked them from highest market cap to least. I'm only showing you the top 20 right now, but on Twitter I posted the top 100. But you got Nvidia, Amazon, Google, Meta, Tesla, UNH, Oracle. Home Depot took a massive fall today. So very interesting stuff to see, and maybe names to keep an eye on, because these could be bellwether type names. They're large market cap names. A lot of people have their eyes on them. They're invested in many different funds, okay? And they're already now 20% or more or more below their 52-week high. In fact, if you go over here, this is 30% or more below their high, and you got Tesla leading the way, ASML, NVO, Palantir, Qualcomm, ServiceNow, right? We got Adobe, which recently reported earnings, got cracked today. AMD, and so much more down this list. So if you want to go to FinViz and take a look, this is a good way to see what's been getting hit the hardest, and potentially maybe once it sets back up, could offer up some opportunities for people that want to buy the dip, so to speak. If we take a look at the SPX on the weekly chart, we've had this divergence start to play out, right? And a lot of people are comparing this to over here going into 2022, where we had this negative divergence on the RSI and the MACD. And what you'll see here is we actually broke the 200-day moving average, roughly the 40-week moving average, and we ripped back up for a bounce, and then we started to kind of slosh back around. And what we're seeing right here, we have one more trading day left in the week, and if we get a big bounce, right, and close up, I mean, it really would look just like this week, right? We saw a couple weeks down, This was a pretty bearish looking red week, and then we closed up near the high. So that'd be a pretty big bounce back if we're going to get it. And then maybe we get some continuation, and then we'll go from there if that's the case. And if you look at the micro charts here, like the 15-minute time frame, we crossed below the 5-day moving average over here, and it started to decline, which gave us our initial warning sign, letting us know that one of the market conditions has been changing. We go over two different market conditions, which we'll talk about. Once again, we talk about it every video. But as you can see, we've just been seeing a series of lower highs and lower lows. And right now, what do we see after today's price action? We see another lower low, but you can see the price momentum oscillator still putting in higher low readings, telling us that the move here is going down, but the internals, right, based off of this calculation for the price momentum oscillator, has been actually upticking. You can even see that here with the RSI. We have a low and a higher low reading, and we have a differential here on the price action, giving us a bullish divergence. So perhaps maybe we do come back up and try to retest this 5-day moving average. Even if we were to pop right back up into here, we're going to start to average 5 days of this data, and eventually the 5-day moving average will start to flatten out and potentially give us an idea of when we can see a potential change in trend, like it did right over there. That's for SPY. For the Qs, same situation. You got bullish divergences here and price action kind of going sideways. IWM, same thing. It's been putting in lower lows. The indicator here itself has been putting in a higher low, as well as the RSI there too as well. Right? And we haven't really seen capitulation in these markets, at least from an intraday perspective. Typically, you can see, like if I'm looking at the advanced decline line for the S&P 100, you can see like 90 stocks all go red, but it just really hasn't been that. It's been like a 60-40 situation most days. And so I've been looking at the percent of stocks above their 20-day moving average and been really kind of waiting to see this thing really hit to the downside. And now we're finally seeing some of these names actually move into more of an oversold, quote, right? Because oversold can remain oversold territory, right? So the NASDAQ 100, right? We have only 9% of the stocks in the NASDAQ 100, or another way of putting this is only 9 stocks in the NASDAQ 100, right? Are above their 20-day moving average. You got the Dow Jones kind of creeping lower there too. It's not quite an oversold condition. The S&P 1500, okay, mid caps are moving into that oversold condition where only it's 11.25% of the stocks. And in small caps too, it's not nearly as low as it once was right here in later 2024 going into 2025, but it is starting to creep down there as small caps have been taking it on the chin lately. S&P 500 is not quite there yet either, but we're starting to see that. If you take a look at something like the NYSE-McClellan oscillator, I love looking for divergences in the NYSE-McClellan oscillator, because it gives us insight to when we could potentially see turns in the market. So if you go back a few videos where we showed this bearish divergence, right? The market kept pressing higher and we're like, oh, this is giving us some sort of a divergence here. Be careful, right? If we start to get under the 5-day moving average, if we start to slip into negative gamma, because it could produce something bigger. And well, it did, right? It turned into a bull trap as we broke out higher and then we slipped off. Now, what I'm noticing here is this is a pretty significant sell-off, but we didn't even get like a minus 250 reading, which is what I would consider more of an oversold condition. This has been just like a little boop, 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 blop, 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 bloop, 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 little drop off, right? Even over here, right? We had a pretty extensive reading at minus 300, okay? And then we made a new low with putting in a higher low here on the reading, and that gave us insight go back to the day when we called it out, right? Gave us insight that we could see the market rip up higher. So we just haven't really seen that blowout type of capitulatory move yet in various different charts. Look at the NASDAQ McClellan oscillator down here, same thing. We've been selling off, right? It gave us some insight. Going below zero is not really a bullish sign. And then on top of that, right, this has been kind of dropping while the market was going flat. So we did have a negative divergence there. But you can see that we never really got a minus 60 reading over here like we did right over here or at the bottom of August, even the bottom of April of 2024, and even January of 2024, which marks some pretty good capitulatory type bottoms. It just hasn't happened yet. If we take a look at the percent of stocks above the 200-day moving average, right, this has been dropping off, and this is for the NASDAQ 100. This has been dropping off to a level that we really haven't seen since, I guess, November-ish, right? November-ish of 2022, which was near the bottom of the market, but the S&P, sorry, the NASDAQ 100% of stocks above the 50-day moving average still isn't even as low as it was there going into 2025. I want to look at some big picture charts now and kind of just once again reiterate the larger picture of things that have happened and where we stand, because I think it's important to know while you're trying to approach it from a tactical perspective, because when market conditions change and the bigger picture looks bearish, you might want to just pull your throttle back a bit when conditions actually change to more bearish. When they're bullish, cool, give it a shot. But when they're bearish, pay closer attention. So yesterday we talked about, once again, the S&P 500 chart. I'm not going to continue to talk about this one all too much, but right, every time we get to these new highs, everyone says this time is different, this time is different. Well, I mean, the inversion, right, the uninversion of this yield curve gave us insight that something similar could happen. And then you pair it with the Fed rate down here when everyone's like, oh, the Fed's going to cut rates, it's going to be bullish. Well, if you just go back through history, it hasn't been, right? It hasn't been. So is this time going to be different? Maybe. But maybe not, right? When we look at history, right, history suggests that it's not typically always different. So, right, can we bounce? Yeah, we can bounce. Did we bounce in 2022 and go up and then down? And yes, okay. This is the KBW Bank Index, and this is a benchmark stock index for pretty much the banking sector, and it represents the largest or the large U.S. national money center banks, regional banks, and thrifts. And I found this chart to be interesting. I've shared this one many times dating back. This is a monthly chart here. So every candle represents 1 month of data. And I have the 10-year, 3-month curve down here. I have the Fed rate just like I did on the prior chart. But I've been calling this the red zone because for some reason, every time we come into this red zone, there's been some problems in the market. So for example, over here, right, when we kind of started, this was the high over here at the financial crisis. You can see where the Fed rate was and we started cutting, right? And then we uninverted over here. Then over here was 2018 when we went into trade war, right? We had all types of global pressure. Over here was the pandemic. Then we have highest inflation, right? We had creeping inflation. And we also had the Russian-Ukraine war. And now, right, we're coming back into this area and we're down 13% on the month, right? That's not a small number. Like JP Morgan is down 20% from its high, and the KBW Bank Index is down almost bear market territory in a single month. So these aren't small moves by any means. I wouldn't know what to name this right now. Maybe this is just trying to signal that there's might be more problems up ahead, or maybe this is all caused because of what's going on with the administration, the constant news feed, the uncertainty that's been growing around tariffs and so forth. Now, another thing that I like to look at is this one. So this is another chart that I haven't brought out for a very long time, the Dow Jones Global Index. And this is also a monthly chart dating back to really 2011 over here, so coming outside of the financial crisis. And what you'll notice is this is a pretty clean channel overall, and you can see we've had a few pops through it, but every time that we come down to the lower level of this channel, the Federal Reserve has done something to save it, right? So for example, we had global glow scares, right? Over here, this was Operation Twist. This is when the Christmas Eve massacre took place, right? Going into 2019. This was the pandemic, which we know led to just a bazooka of quantitative easing that shot us to the upside actually of this channel. And then we went into the higher inflation, and the war brought us right back down to the end of the channel. And now we're starting to get back up to the upper ends, and we're getting rejected from it. And we do have a bearish divergence on the price per percent oscillator or percent price oscillator, same with the RSI. So for if any reason we're going to continue to just find a way to drizzle down here, pay very close attention to the lower end of this channel, because chances are if we get down there, which would be a huge move for a Dow Jones Global Index, we could very well have the Federal Reserve or some other form of stimulus or backstop come in. I find this chart to be interesting too. This is the Russell 2000 ETF IWM, right? We got the Fed rate down here. This is Russell volatility. And then we have the 10-year, 3-month. And this just goes to another bigger picture chart going back to the financial crisis. We've been in this channel. It's been kind of trending up. IWM is basically going into bear market territory as of right now, right? Maybe we get out of it tomorrow, right? Well, who knows? It's floating around about almost minus 20% from its high. And what you'll notice here is when the market is going up, when does it actually go up? When were the biggest two rallies, right? When was this big rally and when was this big rally? Well, look at what the Fed rate did. The Fed rate was basically slammed to nothing, right? So what's that telling you, right? Small caps are a good barometer on the economy. And when money's cheap, I guess the economy does quite well, right? I guess people like spending money and and really driving up these smaller cap stocks. I mean, that's one way of looking at it. And then when we see the sell-off and or when we start to see it flatten out and potentially turn down, what do you notice happen in the federal funds rate? Well, it's actually when they start to raise rates and start to flatten out. When they start to raise rates and flatten out, what happened? Price went sideways. Price went sideways. What happened when they started raising rates? Flattening out. Price is going sideways. And now we're starting to cut a little bit as the yield curve uninverts, right? So slope this up, boom. Slope this one up, boom, right? Slope this one up, boom. And what do you notice here? What causes them to cut rates or drop rates at a faster rate? Well, we typically see some sort of vol event where volatility shoots up incredibly high. So this is the RVX. We shot up to around 80. Right? And then the Fed stepped in. Over here, look at this big move in volatility. Russell volatility came up to about 60 or 70. So perhaps maybe if we start to see a big vol event trying to take place here in the future, right? It doesn't mean it has to happen tomorrow or even this year, but maybe if that's the case, could be something to watch. Now, as the market has been kind of coming off, I've been watching this pretty closely. I'm looking at the CPC, which gave us first and foremost, it gave us indication that things were too frothy, which is why we talked about the bull trap. Okay. And I'll tell you what the flip side of that is. And then I'm looking at skew paired to it because skew gives us a good idea of like, hey, well, what are they hedging for? What are they doing right now? And you can see skew has just been on this monster move. It's basically all-time highs not too long ago as the market kept pressing higher and higher. So there was protection being put in place. And finally, this is actually better to see skew coming off hard and fast. So this is not at an extravagant low reading by any means, but sometimes what you'll notice here is if we start slipping into 115 territory, take a look where we were there, take a look right over here. You can see that that actually kind of marked the bottom there in 2022, and it also marked the 2022 to 2023, and then it also kind of marked the pandemic low. But if you look back up now to the total put to call ratio, what do you also notice? When this thing blows out to the upside and gets around 1.2, that also pairs pretty well. So for whatever reason, if we get some crazy capitulatory event, which drives skew down and we drive the put to call ratio up even further, that could give us indication that, hey, we could have somebody step in here to protect us and or that's a capitulatory bottom in the overall markets. So another thing to watch for is just the put to call ratio to kind of creep up to and around 1.0 if it can actually get there. And when I say put to call ratio, I'm looking at it from a 10-day moving average perspective, not just the put to call ratio in and of itself. Let's take a look at some of these divergences that we talked about and where they stand right now. So the housing market, HGX, the housing index, right? If you go back down to 2005 when it peaked, it started going down and the S&P 500 continued to go up, gave us inclinations that, hey, there could be something bigger taking place. You never want to see the markets like the S&P 500 and the housing market diverge for long periods of time because they typically will need to resolve at some point. So if we take a look at this from even a shorter perspective, just a few years, take a look how the housing market going into 2022 didn't make a new high, but yet the S&P 500 kept pushing higher. On the flip side of that, look at the bottom of the 2022 bear market. Housing market put in a new high, or a higher low, I should say, and then we put in a lower low in the SPX. So the housing market actually told us that, hey, things may potentially be getting better here. And more recently, the one that we were talking about was how housing index kept on kind of dropping off here while the S&P 500 kept trucking up. We'll take a look. It's so easy to understand this in hindsight, but when it's actually taking place, when we point it out, it's typically ignored, or it's like, oh, this doesn't matter this time, or X, Y, Z. So what do we look for? Well, if the housing market all of a sudden starts putting in a higher low, right? And then the S&P 500 puts in a lower low, like kind of like how it did over here. Hey, maybe we can come back to this and say it again. Okay, look at value line geometric index, so like an equal weight. Same thing, right? This puts in lower lows, lower highs, sorry, while the S&P 500 puts in higher highs, and it's been good indication that the market may come off. You can see from this high, it actually kept on putting lower highs. This kept on putting in higher highs, giving us an insight that's saying, hey, this very well might play to the downside. So once again, on the flip side to this, if we start to see a higher low, right, or matching lows while this puts in a lower low, we can come and revisit this. Here's another chart that I shared quite some time ago. This is the percent of stocks above the 200-day moving average in the NASDAQ composite. And we talk about how it's important to continue to watch this as a breadth indication, but to also be aware that these type of things can last for years or a year, right? So you can see when we have smaller amount of stocks that are performing stronger, but yet the market itself is going higher, it's been giving us warning signs that we could be coming into a turbulent period. For example, when we had our bazooka of quantitative easing, we shot up so significantly high. All stocks were performing good, but then this thing all of a sudden started to change. More and more stocks broke down. More and more stocks broke down, but the market kept on continuing to press higher. That gave us warning signs saying, hey, this is getting pretty darn frothy here. Now, that lasted for an entire year. And then we went into our bear market. Take a look over here. We put in a higher low reading, meaning that more stocks now are above their 200-day moving average, but yet the market's crumbling. That gave us indication that we could be finding a bottom. Okay, where are we right now? Well, we started seeing lower readings. The market kept on pressing higher. Now we're resolving ourselves. So where can be an oversold condition if it wants to continue to capitulate? Well, down here at around 15 to 20%, we've noticed that when it comes down into these levels, it has marked some significant bottoms or near the bottoms of the market. Take a look at these divergences that have been building. This is one that I haven't shared for quite some time. If you're familiar with Dow theory, this is another kind of way of looking at it, right? People look at the industrials and the transports and so forth. Up here is the Dow Jones Composite Average. And for those that don't know, the DJA, right? The Dow Jones Composite Average, it's not the industrials, right? The Dow Jones Composite Index is comprised of the industrials, the transports, and the utilities. And what I found interesting here is the industrials were matching up new highs, right? Matching new highs over here. But the thing was, transports and utilities were completely diverging over here. And sometimes when this is the case, if these don't resolve and start to match what's going on over here, one, the Dow Jones Composite can easily start to slip off if these divergences build. But it's also indication that Dow Jones Industrial Average may come off there too in the near future. Now, another way to look at this, a more newer age, is to look at compared to the Russell 2000. So take a look here. This one is the Russell 2000. Up here is the Dow Jones Industrial Average. And take a look how we were making new highs. That's what these red lines are. New highs in the Dow Jones Industrial Average. But what was small caps doing at the time? They were telling a different story. We put in matching highs or lower highs. Lower highs. Remember this over here in 2021 going into 2022? Everyone was talking about this big breakout. Well, we had a massive breakout. But what happened over here? We came back in, being a bull trap, but yet the Dow Jones Industrial continued to press higher, and then we led into a bear market. Even over here more recently, we had matching highs, and small caps was just not confirming this move. And once again, it looks a lot more obvious in hindsight. Take a look over here though. See, Russell 2000 actually happened to put in a higher low while the Dow Jones Industrial Average kept on continuing to press lower. And that gave us insight to what? The bottom of the Dow Jones Industrial Average move over here. If we take a look even dating back further to 2007 to 2008, right? Because people probably want to know about this. Industrial Average put in a new high. Small caps did not confirm, led into the financial crisis. I know it's not this easy to understand this or to just make a call off of this, but it's something to have in your pocket, right? And it's a piece of data that has historical, evidence or historical proof that it has worked and that it has mattered in the past. Let's take a look at our current market conditions. First and foremost, we like to look at the backwardation, right now, currently of the VIX futures curve. This has kind of been a hot topic here, and it's telling us really in layman's terms that, hey, we got problems right here and now, and we see problems kind of resolving into the future. Typically, you don't want problems here right now. You want to know that we can have problems into the future. And as this is going on, right, back month versus front month is still rather extended in an area that does suggest that we can start to try to find our bottom around here. It's been about 4 or 5 trading days, maybe a little bit less, that we've been under this 1.0 marker, which I don't have the chart with me right now. And we can very well elevate from these levels still, which we've discussed earlier on this video. If we take a look at one of the main market condition elements that I use, which is the gamma flip line, we've been under this now for like 15 trading days, I believe it is. So 15 trading days, we've been under the gamma flip line. And this is where selling begets selling, buying begets buying, and volatility typically increases. You can see that here every time we've been in negative gamma territory. I've highlighted it in gray boxes, and you can see this entire run right here has been in negative gamma. So the day that we crossed through it, we were probably on a live stream where I talked about it, to the minute when we cross under it, to be more cautious and aware given the context of the bigger picture. And well, we've continued to kind of just press lower here, looking for opportunities, looking for bounces, but being well aware that market conditions are still not that great. The second thing that I use is the direction of the 5-day moving average, which we talked about at the beginning. Look, we're well off the year-to-date VWAPs, well off the year-to-date VWAPs on the SPY, Q, IWM, and so forth. And we are still putting in lower highs and lower lows with a declining 5-day moving average. There is somewhat of a bright light over here, semiconductors. It's starting to kind of turn over here, and semiconductors, right? If this puts in a higher low and we're getting lower lows over here, this one is a big element to the NASDAQ composite, right? Semiconductors are a big portion of that. And it's also a big growth carrier of the markets and has been. So if semiconductors turn around, that could be a good inclination that we might be seeing Qs and SPYs getting ready here, finally, right, for some sort of rally and or relief from what this current sell side has been giving us as of now. Let's look at expected moves. We're actually still within the quarter-to-date expected moves. We still got time left in this quarter. We blew out of our monthly implied move, and we're currently outside of the largest weekly implied move all year. And what I find so interesting still to this day is we still haven't had capitulation. Now, if we don't get that whole blowout of the advanced decline line, which I've been looking for, this is still could be very well capitulatory, going into a large expected move and seeing these like 2 standard deviation moves from it. That can still be kind of considered capitulatory, especially when last week we actually closed outside of it too. So when you have multiple weeks close outside of the weekly expected move, it's telling us that the market is unstable. It's not doing its job at handicapping risk. And that is typically the time where you can step in and then start to see some sort of a rally of sorts. Okay, so that would be, if we close down here, that'd be 2 weeks in a row. I don't know if we'll close down there, if we'll rally back up to it, right? But that would be the case there. Now, if we look at tomorrow's daily expected move, the upper level is at about 550. I'm just gonna go 558 and to about 560, and then that puts us darn near close right back to the lower weekly implied move. If we do bounce up into these ranges, gap up, watch for that week to date volume weighted average price. That has been the thing that's been kind of just driving this market a little bit lower. We have not been able to get above it and hold it. It's a very important anchor VWAP. So if we don't get above it next week, pay attention to it. Even if we do get above it next week, pay attention to it, because if it comes back, it may act as a level of support, because once support is broken, it can potentially become resistance. If we do break down tomorrow, look at underneath the quarter to date. Now, if we break through the quarter to date, this is interesting to me, because we still got time in the quarter, 1, and then 2, the seasonal script has been kind of matching. So if we break through this, we're underneath the quarter to date. We've seen 2 weekly closes outside of the weekly implied move. Seasonality starts to pick up around this time. To me, that would be looking for getting a little bit more aggressive on dip buying. So that's what I would be paying attention to if it were to even come down into those areas. And if we take a look at the Qs, guess what? We're right there at that quarter date. We actually came into it today. We bounced up. We came back down. Going into tomorrow's trading session, the lower weekly implied move is where basically the daily implied move is. So screenshot it, put it on your charts if you want to. The month to date expected move, right? We're basically floating around right over there. It's slightly above us. And then if we start to crack down a little bit lower, that would put us underneath the quarter to date and back there at the daily 461. Remember, we're still below a declining 5-day moving average. We're still in negative gamma territory. We've seen a lot of these divergences start to play out. So what do we do now? We pay attention that when things get better, hey, you can put our foot back on the gas pedal, but be aware of the overall big picture charts that I previously discussed, because if we start slipping back under the 5-day moving average and it starts declining, if we start slipping back into negative gamma territory, once again, things could get ugly, and they can be ugly for quite some time, which we're experiencing right now. Hope that helps. I'll see you later.